Alright, so we're going to work this example exam. Everything should look very familiar, however, it has maybe been a few weeks since you've done some of these Excel applications. It can get frustrating because it seems like almost completely new information because you haven't seen it in a while, but it should come back to you pretty quickly. So remember what we did. We put the rate, we put time, we put the target down, that what are we trying to accomplish, and then we have the factor, either the present value interest factor of an annuity, or the present value interest factor annuity, or the future value interest factor of annuity. And remember, the present value equals the present value interest factor annuity times your payment if you're borrowing money, and the future value equals the future value interest factor annuity times the investment when you're investing money. So you don't know which problem I'll give you, but let's look at this one and just see. Fosse is saving. That starts to sound like a investment question just from the get-go. So it's not so if he's borrowing money to buy something, that's probably going to be a present value interest factor problem. If he's saving money to buy something in the future, then that's probably going to be a future value problem. So you got to look and see what he has. So he wants to start a medical practice in 10 years that he wants to name after himself. He expects the practice to cost $400,000. So there's your target. Sounds like he wants to save $400,000. He will invest a fixed amount each month for 10 years. So fixed amount each month for 10 years. Remember how we did the time? We're going to take 10 years times 12 months per year. So what is that going to be? Plus 10 times 12. So we have 120 months that he's going to be saving. What is his rate? He's going to make 5.76, but remember what we do, we take the annual rate and divide it by 12 for 12 months. Now if he was doing this weekly, you would multiply by 52 and divide by 52. So it would be 10 years times 52 weeks, and it would be the annual rate divided by 52 for 52 months. We're here in 52 weeks, but here it's months. So be real careful that you do 5.76%. Some students get in a lot of trouble. They don't convert to percents. That divided by 12, and that will give you that monthly interest rate. What's the present value interest factor? So we want 0.48 and 120. That first column is not correct because it's 12. It's not 120. The second column is not right because it's not 0.48%. It's 5.76. So only the last column is correct. So the present value factor is going to be 91.0588 and 161.7623. Now, if you want to use your file that you created for the Excel applications and use the actual formulas, that's fine. You can do that. But if you want to, you can use this table. The advantage of using the file you did for the project, for the Excel application, is that you won't have the rounding problems that you'll have here. So remember, the first column is time. Then we have the beginning balance. We have the interest expense. Or here's interest earned, right? Because we're investing. And then we have the investment. And then we have the ending balance. How many time periods we have? We have month 1. The second month, you take plus 1 plus that 1 plus 1. You copy that down. I'm starting at line 120, so I'll probably need to go down, since I need 120 lines, probably go down to about 140. That would probably be about right. Do my control down arrow, went one too many. So down there. Alright, On the exam, you don't have to clean it up and pretty it up, but I just can't help but do that. So let's get it so we can see it. What's our beginning balance? Well, if it's an investment, your beginning balance will be 0. If it's a loan, your beginning balance would be whatever you're borrowing money for. So he's not borrowing money here, he's investing. So keep track of that. So you need to practice some of those problems from Excel application 1 and 2. Most of those are actually borrowing questions. So this one is an investment question. So investment questions, you start with 0. What's the interest earned? Well, the interest earned or the interest expense, it's the same. It's the beginning balance times that rate. Make sure you lock in that rate with the dollar signs. I'm going to change that to a dollar sign. What's your investment? Remember your investment. So we have the future value equals the factor times the investment. So that means that the investment is going to equal the future value divided by the future value interest factor annuity. So in this case, we're going to take $400,000 and divide it by our factor. So we're going to invest $2,072.76. Our ending balance. Remember, if you're investing, you add everything across. If it's a loan, remember, if it's a loan, you take beginning balance plus the interest expense minus your payment. All right, then your beginning balance is just your ending balance from the time before. Interest earned, you can actually just copy that one down. Your investment, remember on the investment, you just reference it. You just hit equal because you want the same number all the way down. That's true. Everything I just did on line 2 is true whether you're doing an investment problem or a present value borrowing problem. You can borrow the ending balance down. The ending balance will be all additions for an investment problem, and addition, and minus. Once you get the second line set up, then you can just copy down. So let's go back and look at the question. Calculate the monthly investments they will be making. Well, there it is right there. He's going to be investing $2,472.76, and then create the amortization schedule. Well, here's the amortization schedule. How do you know if we did it right? When we go down to the end of 120, and we should be really close to $400,000. Why isn't it exactly $400,000? Well, because we're using these rounded factors. That 161.7623, it's got several more decimal places. So if you use the actual formula in your Excel from the Excel application, it should be fine. So the key here, is this an investment question or is this a borrowing money question? If he was borrowing money, let's say he's going to build a building today, and he's going to borrow $400,000 today, and that's his interest rate. Well, in that case, if he's borrowing money, you would start with $400,000. His interest would be interest expense. Investment would be a payment. And here, instead of dividing by the future value, you divide by the present value. And then you remember your ending balance, all you do is you subtract. And then if we copy that down, then the very, very end should be really close to 0. Alright, so hopefully you remember the difference just one more time. If it's an investment problem, your beginning balance is 0. Your interest, it's interest earned, but it's the exact same formula, whether it's expense or earned. Beginning balance times your monthly rate. The payment, if it's a borrowing problem, you take your target amount, whatever you're borrowing, divided by your present value factor. If it's an investment problem, you take whatever you're trying to invest, what you want your portfolio to be, divided by the future value. If it's an investment problem, you add the 3 balances. If it's a borrowing problem, you add the beginning balance, add the interest expense, subtract the payment. If it's an investment problem, then your last cell should be your target amount. If it's a borrowing problem, your last cell should be right at 0. Alright, so there's question number 1. Let's jump to question 2. So the second problem is a cost-benefit analysis problem. So remember on that, you need to have the WACC, the weighted average cost of capital, and you need to have the payback standard. The WACC tells you in the problem is 5%, so we'll type 5%. Make sure you type 5% and not 5. 5 would be 500%, so make sure you have 5%, so use the percent sign. Your cutoff is 2.5 years. They give you that right there. Remember what we did before, you start with time, you have your cash flow, you have your cumulative net present value, you have your change in the net present value, you have percentage of year used. So you have to remember that the payback is the most complicated part. So I might not do it exactly the way we did it in the Excel application. So you start off with the date, you start off with today. And then the second time we're going to use a half year convention, so you add 182 days on the second year, and then you add 365. How many years do we have? 1, 2, 3 years. So you do that down, so you have, fortunately, there's no leap years in there, so we don't have to worry about that. So 5/2, 1031, 1031, 1031 at time 0. The initial investment is $750,000, so we type that as a negative number. There's $275,000 in the first year, $295,000 in the second year, and $325,000 in the third year. If it's dollars, I like to show it as dollars. So we can do our IRR, our NPV. So our NPV is equal X MPV. And actually show you here what you do, rate, value. So Bill Gates is letting you kind of cheat on the exam, but that's okay. I'm more concerned with you knowing how to use Excel than to plug this into a calculator. So there's our net present value. And our RRR, remember the same thing, equal XIRR. You do the values just like it says there. You do the dates. You get 12.37%. Now, if you do this on a different day, it's possible, depending on if you add the 182 or the 366 or whatever, it's possible you get a slightly different answer, but if you're in the ballpark, you're probably fine. So the cumulative net present value, here I'm going to do this maybe a little bit different. You start off in the deficit, and then what is it after that? You do equal X NPV, do the rate, lock that in, comma, you do the values, comma, and you do the time. Close that and go back. Remember on the date, on the values and the date, you want to lock in that very first date, the 205. You don't want to lock in the second one. So when you copy it down, the very last one should be your net present value. And then we have the change in the net present value, so we take the net present value at the end of year 1 minus where we started. And you can do that all the way down. I might have done this a little differently where I didn't have the cumulative in there. You got to be real careful because there's no percentage of year here because this is time 0. There's no time here. It's 0 time. So remember what we do. We say, hey, let's see if I can get this right the first time. If it's negative here, less than 0, then we need 100% of the year. However, if the current year is not negative, then we got to ask, was the previous year greater than 0? If it was, we don't need any of this year. If it wasn't, then we want to take how much the deficit was here, and we're going to divide it by, now here this first year doesn't work, so divide it by, we take the deficit at the end of the previous year and divide it by this year's present value. Bill Gates doesn't like something. So if this is less than 0, you need 100% of the year. Otherwise, I forgot to put the if. If it's the previous year is greater than 0, we don't need any this year. But if the previous year is negative, then we want to take minus the previous year and divide it by this year's net present value. Let's see if this works. I'm always a little bit skeptical of this. This looks right, so let's do the payback. The payback, you just sum these. Now the advantage you have is that if you have the Excel application set up, then you might be able to use the existing framework, and then you won't have to change anything, because this problem looks a lot like that, and you're fine doing that. Just make sure you have some checks that the cumulative net present value should equal your net present value, that very last one. Does this look right? Well, at the end of the second year, we had a deficit of 207. You take 207 and divide it by this year's present value, and you get that 72%, so that looks right. The last thing you got to do is do the accept or reject. So you do if the net present value is greater than or equal to 0, then you want to accept. Otherwise, you want to reject. On the IRR, you do equal. If the IRR is greater than or equal to your WACC, then you want to accept. Otherwise, you reject. And on the last one, if your payback is greater than your standard, well, if it's less than or equal to your standard, then you accept. Otherwise, you reject. Alright, so let me put some formulas in there so you can just see them. If you want to put pause. But that's the entire problem. That's what I'm looking for. So when I say explain, 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 all you got to do is you can explain it in the formula. If you have the formula set up correctly, I'll accept that as you're explaining it. So there's your formulas, and I'll put the cumulative net present value formula over here. I'll put the change in net present value formula over here. And then percentage of years used, which is the hardest one, I'll put that down here. So you've got all your formulas in there, so if you missed anything, you can hit pause and you got all the formulas laid out for you, and that gives you that problem too. Yeah, and the paybook back, I like to do the payback as not as a percent, but as 2.72 years, so it exceeds the 2.5, but everything else is accept. Alright, let's do the next problem. The next problem is quite involved. So what we're going to do is we'll put all the data that we need. So we're going to first determine their beta, then we're going to get their cost of capital, we're going to get the value of their bond, and we're going to get the value of the stock. This is the most complex question of all. So let's start off with what is their beta. So remember, on the beta, you have revenue sensitivity, you have operating leverage, you have financial leverage, and you have the history. So let's look at this firm that we have here. It's a firm called BWA. They manufacture and sell car parts. So I'm going to say this is a cyclical business selling parts for cars, so beta well above 1. Operating leverage. So we look over here, you know, it's probably heavy union, high property, plant, and equipment. And we look at their net margin, and their net margin standard deviation is lower. So we would expect them to have high operating leverage, high fixed costs because they have a unionized labor force. They have a lot of property, plant, and equipment. However, their net margins are very stable. Their net margin standard deviation is 3.58%. That's much lower than the stock market. They rank in the top 30%. So I'm going to say, you know, it's above 1, but it's not, but does not push it up much. So this gets a little tricky, what words you use here. Do your best to try to handle that. You did it on the Excel application when you came up with the beta. So do your best to try to explain it. I'm looking for, you understand firms that are very sensitive to the economy. Use your best guess on that. You know, grocery stores are going to have low betas. Discount stores like Walmart will have low betas. Firms that sell what we call consumer staples, things like groceries and utilities and probably medical care, they're going to have low betas. Firms that sell consumer discretionaries like cars and vacations and airfare, or they do heavy manufacturing, they're going to have high betas. So do your best to explain that. Financial leverage is the easiest. You just look at their debt to equity. Their debt to equity, lower debt to equity than average stock, pushing beta back down closer to 1. And then we look at the history. Here's the history. You can see the mean is right around 1.5, and recently they've been well above 1.5. So history suggests around 1.50. I'm going to say now you come up with your own number. I'm going to use my own number here. I'm going to say given the low standard deviation of net margin, I'm going to use 1.40. But anything, you definitely would want to be well above 1. It's pretty obvious from this chart, well above 1. Most of y'all would probably use 1.5, I think. I'm going to use 1.4. 1.5 would be correct. So now we got our beta. Our beta is 1.4 or 1.5 if you use 1.5. Use 1.4 for this case so you can get the same answer I get. Alright. What else do we have? Alright, so remember for the WACC formula, the weighted average cost of capital, it equals the weighted debt times the cost of debt times 1 minus the tax rate plus the weight of equity times the cost of equity. The cost of debt equals the risk-free rate plus the spread. The cost of equity equals the risk-free rate plus beta times the market or equity risk premium. I think in this case I call it the equity risk premium, but they're the same thing, market risk premium or equity risk premium. Alright, so let's put all those in there. So we need KD. Well, let's get the risk-free rate for bonds. Let's get the spread for bonds. Let's get the risk-free rate for stocks. Remember on that we always use the 10-year treasury. We've already got the beta up here. We don't need to do that. I can move it down though, so you might want to move it down. And then we have the equity risk premium. Alright? And then we need the weight of debt and the weight of equity, and we need the tax rate. If we do all of that, we should be able to get the WACC, which is the first question. So let's go up here and look and see what they tell us here. this is very, very important information right here. Their only debt is a 20-year bond issued 18 years ago. Remember, if it's a 20-year bond issued 18 years ago, it has 2 years remaining. For as far as you care, this is a 2-year bond, and today it's rated BBB+. That's all you care about. How many years are left and what is it rated today? If I tell you what it was rated 18 years ago, you don't care. That's not important. This is a 2-year bond rated BBB+. This might be a little different than your homework problems, so this is a good chance for you to do some critical thinking. I do like a little bit of an exam for you to, students say, I couldn't do it because it wasn't exactly like what we did in the homework. Well, that's not good. That means you're not learning the material. So I'm throwing a few really minor little curves in here, but nothing really that major. So it's a 2-year bond, so there's 2 years, and it's BBB+, so the spread is 85. Okay, so we'll do a spread of 85. Remember, for the spread, you take 85 and you divide by 10,000. Hopefully you remember that. So you take the spread from the table divided by 10,000. All right, what's the risk-free rate for bonds? Well, let's come back up here. Up here, it's a 2-year bond. So if it's a 2-year bond, we use the 2-year treasury rate. The 2-year treasury is 0.6%. So we do 0.6%. Make sure you type it as 0.6%. What's our risk-free rate for stocks? Well, we always use the 10-year treasury for stock. The 10-year treasury is 0.9%. So 0.9%. And our equity risk premium, there's the equity risk premium right there, 6.4%. The weighted debt, so come back up here. Here's the information here. Their only debt, let's see, they have $1.5 billion in debt and $4.5 billion in equity. Alright, so remember on the weights, you take 1.5 billion divided by 1.5 billion plus 4.5 billion. That gives you a weight of debt of 25%. And then for the weight of equity, you just take 1 minus the weight of, plus 1 minus the weight of debt. And that gives you 75%. Make sure they add up. So the weight of debt is the amount you have in debt, 1.5 billion, divided by the amount you have in debt plus the amount you have in equity. And then your weight of equity is just 1 minus your weight in debt. What's our tax rate? Gotta find that somewhere in here. Here it is. Their marginal tax rate is 21%. Before we do the WACC, let's move the WACC down. Let's get the KD and let's get the KE. Remember, KD is real simple. You just take the risk-free rate for bonds plus the spread. So our KD is 1.45%. Our KE is the risk-free rate for stocks plus beta times the equity risk premium. So our discount rate for the stock is 9.86%. So what is our WACC? Remember the WACC, weighted debt times cost of debt times 1 minus the tax rate plus weight of equity times cost of equity. So weight of debt is 25%, cost of debt is 145 times, open parentheses, 1 minus your tax rate plus weight of equity times the cost of equity, and I get 7.68%, checking that against the teacher's key. So we've answered 2 problems so far. There's question 1. There's question 2. You go back up and look at it. Question 1, determine and fully justify your beta. And it said come up with a discount rate, so that's the KE. You don't have to label this as 1, 2, 3, 4. As long as you have them all in there, I'll find them and I'll grade them. So there's your question 1. Our beta is 1.4 and our KE is 9.86%. The second question is calculate the weighted average cost of capital. So there's that. So there's question 1, question 1, question 2. Alright, so what's question 3? Question 3 is assume a face value of $1,000. Determine the current price of this bond. Alright, so the price for the bond, we need the KD. We've already done that. That's that 1.45%. What's the face? The face is $1,000. We need the coupon. What is the coupon? The coupon is BWA's only debt is a 20-year bond issued 18 years ago with a coupon of 7%. This might be the hardest part of this problem is finding all that data, but if you know what data you have, if you set it up correctly in Excel, you can just, as you find them, in fact, I would print this problem out or have it on another computer or on your phone or something so that you can see the problem while you're working it out. If you don't have access to a printer, then find some way, get it set up. This is your exam. Get it set up as best as you can so that you can see the materials. All right, so there's your coupon. So what do we need? We need the effective yield. Hopefully you remember this formula. The effective yield is 1 plus the KD divided by 2, close parentheses, raised to the second minus 1. So in this case, we'll do open parentheses, 1 plus our KD divided by 2, close parentheses, raised to the second minus 1. Remember, it has to be slightly higher than the KD. And here it's 146. And then we just set it up. At the end, we have time, we have cash flow, we have the discount factor. You did this in an Excel application. Then you have the discounted cash flow. So if we set all those up, how much time do we have? Well, it's a 2-year bond. So we start in 6 months, and then we add 0.5 to each one of those, and you go out, since it's a 2-year bond, you go out 2 years. Is it possible I might give you a 5-year bond or 10-year bond? I mean, that's possible. Your cash flow, remember your cash flow is going to be the face times the coupon. That's your cash flow. So we take the face, and, well, one extra thing in there, times the coupon divided by 2, because remember they pay twice a year. So we take the face times the coupon divided by 2. That's $35. You want to put that in every row so that you calculate it in the first row and then you just reference it. You just equal that. And then remember at the very end you get your $1,000 back. So your cash flows should be the same number 3 times and then that number again, but with $1,000 added to it. Your discount factor, remember on your discount factor, that's going to be 1 divided by 2 parentheses, 1 plus your effective yield, close 1 parentheses, raised to the time. So we'll do equal 1 divided by 2 parentheses, 1 plus our effective yield. Got to lock that in. Close 1 parentheses, raised to the time. You don't lock that in. Close your last parentheses. You should have something that's 0.99 or 0.98. You can copy that down. Remember, each one should be getting slightly smaller. Then your discounted cash flow, you just multiply across. And so what does that give you for the value? You just do equal sum. And you get 1109.02, which makes sense because the coupon's 7%, but the market's only paying 145. So to get someone to sell you this bond, you want to buy it from them, the best you can do anywhere else to get 1.45%. This one's paying 7%. The only way they're going to sell you this bond is if you throw an extra $109.02. So there's the question for answer for number 3. Number 6 is assume a face value of $1,000, determine the current price of this bond. The last one is the stock using these 3 models. So remember, for the stock valuation, what do we need? We need KE. We've already gotten KE, right? We did that up above, 9.86%. We need the dividend, 0. We need earnings per share, 0. We need the long-term growth. We need short-term growth. We need the H, and we need inflation. So let's see if we can get all of these numbers here. I'm going to bring this down so we can see it. So with the looming threat of autonomous vehicles, security analysts expect earnings growth to be negative 5% next year. So our short-term growth is actually negative 5%. And moving back to the long-term growth rate over the next 5 years. So remember, your H is 5 divided by 2. So whatever we have here, usually this is a positive number, but here it's actually a negative number. That's going to be your short-term growth. And whatever this time period is, your H will be that divided by 2. So 2.5. Alright, that's all we need out of here, so we can take that back up to the top. What else do we want? Well, let's take this and move it down to the side. So the inflation assumption is 2.5%. We already used the beta, we already used the equity risk premium. The dividend, the last 12 months, that's $1.45. Earnings per share is 3.61%. I'm sorry, $3.61. I don't know why I typed that, sorry. Long-term growth is going to be 4%, whatever is there for that long-term growth. So you can use that as your long-term growth, 4%. We should have everything. So we've got the dividend discount model. We have the cap earnings model, that model I created, and we have the H model. So each one of these is just a matter, you get to look them up. The normal class, they don't get to look them up, they have to have them, they just have to know them. If you are a finance major, you should know all of them by heart. Let me get rid of this up here. So dividend discount model, it's dividend 0 times 1 plus the long-term growth, close parentheses, divided by KE minus long-term growth. Cap earnings model is earnings per share 0 times 1 plus inflation, close parentheses, divided by KE minus inflation. Make sure you have your parentheses in the right place. The H model, remember, it looks a lot like the dividend discount model, but we have to add an extra parentheses at the beginning of it. And then in the numerator, we're going to add dividend 0 times H times, open parentheses, short-term growth minus long-term growth. So that's that formula. It looks an awful lot like the dividend model. So let's just do each one of these. And I'll be checking it against my number to make sure I have it. So dividend 0 times, open parentheses, 1 plus long-term growth, close parentheses, divided by KE minus long-term growth. And I get 2573, and that's correct. Cap earnings, I do earnings per share 0 times 1 plus inflation divided by KE minus inflation. Gives you 5028. And then the H model, You need to open parentheses at the front. So dividend 0 times 1 plus long-term growth, just like we did with the dividend discount model, plus dividend 0 times H times, and you take short-term growth, even though it's a negative number, you still take that number, minus long-term. So we're actually multiplying by negative 9%. Close parentheses twice, divided by KE minus long-term growth, and you get $20.17. So there's your answers to number 4. There's number 4. So we've covered everything. All 4 questions are in our answer. So that's that next problem. That's the most involved one. You got to practice that one. Do not do this problem thinking you're going to look things up as you go, because it's just not gonna. You're not going to have time. All right. The next few problems are pretty simple. So the economic value added problem. Remember, you just set up the income statement: revenue, expenses, interest, expense. So our revenues is $8 million. Our expenses are $7 million. Interest expense is $400,000. Make sure I keyed them all correctly. And so what is our accounting profit? We take revenue minus expenses minus interest expense, $600,000. So this expenses includes $80,000 depreciation, and that $1.2 million salary. What are you going to do with that? You're going to ignore that salary. That's just bogus information that you don't need. All right. So now we're going to add back depreciation, and remember you add back the interest expense. So the depreciation is $80,000. The interest expense is $400,000. And what does that give you? That gives you your economic profit. So you take your accounting profit plus your depreciation plus your interest expense. That gives you $1,080,000. All right, so let's get so we got the economic profit. Let's get the cost of capital. So the cost of capital, remember we have capital employed and the cost of capital. So we have debt and we have equity. How much debt do they have employed? Go back into the problem. She borrows $4 million. I mean, she uses her own money, her own money of $4 million, and she borrows $5 million. So this $4 million, let's bring this down so we can actually see it. We're working the problem. So she uses $4 million. I'm sorry, she borrows $5 million. Don't get these mixed up. She uses $4 million of her own money. So there's her capital. So total capital employed is $9 million. What's her cost of debt? Cost of debt is 8%. And her cost of equity is 4 points. She believes equity is more risky than investing in the stock market, so she has a 14.75% return there. So her cost of capital, we got debt, we got equity. How much is the debt? We've already calculated it, $400,000. Let's just double check it. So you take total debt times the cost of debt, and sure enough, that gives you $400,000. Cost of equity is just your equity times your cost of equity. That's $590. So your total cost of capital is just the two of those together, or $990,000. So what's our economic value added? Economic value added is your economic profit minus your cost of capital. Remember, we have a return on invested capital, We have the cost of capital. Return on invested capital is going to be your 1080 divided by your total capital, or 12%. And try to go out 2 decimal places. Several of you on your Excel application didn't go out 2 decimal places, and so the actual economic value added was 0.75%, but you showed it as 1%. I didn't count off for that, but it's much more accurate to go out 2 decimal places. Your cost of capital is 990. Divide that by 9 million. That gives you 11%. So our EVA spread is our return on invested capital minus cost of capital, or 1%. So the problem says, give me the EVA in dollars and give me it in percents. So there's your answer. All right, one last problem, simple problem. I know there's a couple other problems on the exam, but we'll talk about those when we do the special office hours, because one's an essay question. You just got to prepare, watch the videos. So I'm not going to go through all that again because it's in the class video. You can go back and watch the class video. If you have specific questions, you can certainly ask them. And the other one is that Excel application of coming up with the beta for a company that I would give you. So you get to choose between one of those 2 questions. So I won't go over those today. So we're just going to finish up with this value at risk. Remember that value at risk equals the mean minus the number of standard deviations times the standard deviation. So here, what is the mean? So if you look at the problem, they say the portfolio is daily expected return. Expected return and mean are the exact same things. So 0%. I like things to go out a couple of decimal places. What's my standard deviation? My standard deviation says 0% expected return with a 1.2% standard deviation. All right, my portfolio value. Some of y'all struggle with this on the Excel application, but it's 1,000 million or $1 billion. So I'm just going to type in as 1,000. We know this is in millions, so that's $1 billion. What's my risk budget? It might be in percents or in dollars. Here it's in dollars, which is the way I normally do it. You notice on this problem, I gave you the portfolio and the risk budget in millions. I think some of y'all got confused on one of the problems because I gave you one number in billions and the other number in millions. You should be able to adjust between those 2. I don't count off if you really mess up on that, but you should be able to do that kind of math in your head. So if you're struggling with that, stop and think about it. You're probably just overly complicating it. What's our risk tolerance? Well, they give us the risk tolerance. It's 1%. So if our risk tolerance is 1%, what table value are we looking for? Well, remember, 1.01 is not anywhere in the table. Now it's on the outside of the table. That's not what we're looking for. We're looking for inside the table. So remember, I'm giving you one side of the table. The table gives you the other side. So you have to take 1 minus that risk tolerance, and you look for that in the table. We know 1%, we've talked about this, is the same as a 2.33 standard deviation event. Because there's that 0.99. Just get as close as you can get. So that equals, so the number of standard deviations is going to be 2.33. Now if you set this up in your Excel application, I actually gave you a formula to do that. If you want to use that formula, that's fine. So what is my value at risk? So I take the mean minus the number of standard deviations times the standard deviation. Remember, we want to do it as an absolute value because it's always a positive number. That gives us 2.8%. Now we need to do our value at risk in dollars. Why in dollars? Because our risk budget is in dollars. So our value at risk in dollars is our value at risk in percents times our portfolio value. That gives us 28 million, our 27.96. What do we say here? If the value, our bar, is greater than our budget, comma, we say that we failed. VAR exceeds risk budget. Otherwise, we pass. VAR is under risk budget. There we failed. And so that's your full answer right there. Now this seems like a lot, but you got plenty of time to study. You work on each problem. Make sure you get each problem down. Do it over and over again. Don't let the fact that it's open notes mean that you don't study as much. You should study for it as if it's closed book. For a few reasons. First of all of your majors, with the possible exception of cybersecurity, but every major other than cybersecurity, should know everything on this exam by heart. Because all those majors, management, actuarial science, finance, accounting, your marketing, you're all going to use this stuff. Maybe not all of it all the time, but you'll definitely use some of it. Cybersecurity will probably use some of this as well. If you're cybersecurity and you want to move up in cybersecurity and ultimately become the CEO of the company, you're going to have to know all of this. So don't learn this for the exam. Learn this as a business major. This is the stuff you should know off the top of your head without having to look it up. So everything we're doing on this exam is stuff you should know. So learn it permanently. Put it in your permanent memory. And the best way to do that is always step back and ask what you're doing. Don't get so into the weeds of putting numbers in the formulas that you don't think about what you're doing. And that way, if you get a really strange looking answer, you get a cost of capital of 43%, you say, wait a minute, that can't be right. I must have typed 2% as 200% or something. And so that will help you a lot. Step back and think about what you're doing. So that's it. That's our practice exam. Hopefully it gives you good review of what you're doing. Go through each problem. If you're finding there's one problem in particular you're really struggling with, and maybe there's others on your team or others in the class, then you can certainly set up time with me and we'll practice more on it. I'll help you whatever you're struggling with. If I've got an error somewhere in here, then definitely let me know and I'll have to fix it, because it's always possible I have a typo somewhere in there. So let me know immediately once you see it. Let me know, or if you're thinking you see a typo and you want to make sure, email me. I get back pretty quick on those type of emails, because I don't like errors being in these type of exam reviews, because it's just frustrating for the people preparing.